Hi there, everyone, and welcome to our first edition of On Track for 2025. So, hope you had a great Christmas, New Year. I want to say Happy New Year. I think we're almost to the end of the month. It's the 30th of January as I record this. We've got all the performance numbers up to the December and all the news right up to date to the last minute, literally. Let me jump in, but before I do, as usual, warning: this video is designed for clients in McGregor Wealth Management, particularly those that use our care investment methodology and care investment portfolios. All other people welcome to listen, but please get advice and do your research before you act on anything that appears in here. So I'm going to cover off on, there's lots happening at the moment, politically, economically, a lot of things going on. So I'm going to cover off on the economic news, how it fits into the market. We'll talk through shares, property, interest rates, and all that stuff, and put in perspective around our philosophy of exciting life and boring money. So in the news highlights this month, obviously, Trump elected in November, inaugurated January the 20th, and immediately goes to work with lots of presidential executive things where he signs off and starts to get stuff done. He's going hard to implement everything he talked about. He is the wild card, make no mistake, for this year. He will potentially be good for the market, but will cause some volatility from time to time when he says or does stuff that the market doesn't like. It's going to be an interesting 4 years. He will dominate. We think he's probably positive for the market, but depending on the extent to which tariffs are put in place as opposed to actually being a negotiating tactic, which kind of looks like that can have some effects that the market may not like, and also depending on how inflationary the spending may be, depending on whether it's backed by restraint and everyone's got one eye on US government deficits. So we're back. When we look at our numbers down the side, the cash rate in Australia is still unchanged. Next month, the Reserve Bank, led by Michelle Bullock, will make an announcement. It'll probably be the last chance of an announcement before Labor calls an election. So Labor's very much hoping for a rate cut to say, look at all the hard work we've done. It's all been worth it. Inflation's down and rates coming down. Maybe not. In the US last night, the Fed left rates unchanged. They used the words "no rush to cut." They're waiting to see what happens, obviously, with Trump, inflation, etc. We've got inflation, inside the bands, both in Australia and the US. US at 2.9, so only just under. Australia at 2.6. But the Reserve Bank likes to look at another measure called the trimmed mean, which cuts out highly volatile items. And it also kind of hides, you'll recall me talking about the subsidy for everyone's power bills, which artificially has lowered inflation by about 0.5%. So the 2.6, so depending on which measure you look at, the mid twos has got that artificial subsidy in it. So it won't surprise me to see Michelle Bullock hold off. Maybe she'll throw the market a little cut. We will see. Opinions are split, and there's still plenty of news to happen before they meet. We had some interesting news over the weekend, at the start of the week. A Chinese AI, artificial intelligence company, released some news about DeepStack, which is their equivalent to ChatGPT. One, they said it was developed with only $6 million, as opposed to the billions that are being spent by the big American tech companies. And they said they developed it without NVIDIA's super chips, the top of the range chips. And the market reacted. It's taken about 17% or 13% off NVIDIA stock. And it's fascinating. It's created a real talking point. I mean, the first thing I'd say is probably three things. One, just because a Chinese company announces something doesn't necessarily mean it's true. They have been known to mislead the market. They may have spent billions of dollars in other research that led to the latest little bit. They may have illegally had access to NVIDIA's chips. There's so many possibilities here. And even if they have done it cheaply, it's actually good news for the broader market, because it means AI will be cheaper to progress for the masses than it would otherwise be. So I think it's a net positive for the market. It's one of the reasons we love index investing, because we're not reliant on any one stock. So if people don't need as many as NVIDIA's super powerful chips, which they still might, by the way, that will help other chip companies, and you effectively own both of them. So you pick up one or the other one drops down. US, even with all the volatility, US and Aussie markets are both close to their all-time highs as I record this. We've had a peace deal in the Middle East, fingers crossed. It's a fragile environment, always at the best of times, so hopefully it will last. We've certainly got Trump and the US pushing for it to last, in the same thing as Trump had promised. He's pushing Russia, and Russia seems willing to open peace talks. Whatever that looks like, we'll see how that comes out. So all of a sudden, we could be in a scenario where we've had two major conflicts, come back. That's good news. And at the very least, it's less bad news. So that'll be good for the world. And then it gets back to profits, interest rates, all the usual stuff. No real change in the interest rate markets around mortgages, slight drop in term deposit rate. And we probably are going to see lower rates this year. It's just a matter of how low and how long they stay low. It's really the big unknown. I don't think rate cuts are going to be as deep as people have expected. So I don't think mortgage rates are going to drop a lot. Maybe there's 0.5% in it this year. So I wouldn't be planning around big drops. And mortgage rates of 6%, excuse me, historically is pretty good. So let's jump in and look at, sorry, I'll just get back one slide. So the performance numbers to the end of the year. And it was a great year. So when we look down the 1 year column, you'll see growth investors 15, 16%, balanced investors 13%. It's evened out the last 3 years. So you can see now the 5, the 7, and the 10 years all pretty consistent. Excuse me. And consistent with our long-term projections. So we had a dip, which you'll see in a minute, in 23, which was a negative year, but that's been made up for by the catch-up here. So returns being consistent. And when you look at the returns of the asset classes right down the bottom, you'll see the charge has been led by international shares and in particular US shares. I've had a comeback from emerging markets, which is good, but still lagging over the long run. Now, on Tuesday night, I recorded a webinar for the broader public, just on my thoughts on 2024 and the outlook for 25. You're going to receive, in parallel with this, an invitation to watch the recording of that. Feel free to watch it. Feel free not to watch it. It's just over an hour and a bit, but it's more detailed in what we're thinking at the moment. So like I said, feel free to watch, feel free not to watch, but there's a deeper dive in some of these things and a good reminder to things you guys are well up to date on. So the downturn, so we're at near those highs, as I said. We've come out of that valley of fear, the last one, which did see performance low in 2023. And right now, the 10-year numbers, the 5-year numbers, they look healthy and normal. But it's inevitable. We'll have another valley of fear, no doubt, this year. Highly probable. But doesn't mean the market doesn't go up as well over the course of the year. In my exciting life, boring money segment this month, I'm still continuing on with private credit. It's a real concern both to me and to the investment committee. We have no exposure to private credit in our portfolios, but we're seeing it pushed a lot. Private credit came into being as a result of people, a few things. Post the GFC, all the banking regulators put restrictions on bank lending. That means there's the credit market for this private lending, where fund managers raise money and then they lend it to corporates. It's probably a good thing, but it's gone ballistic. So it's gone from $297 billion to $2 trillion since GFC. So absolutely massive. And it's now as large as the normal bond market, which are quoted on market. One of the dangers of private credit is it's very hard to see what's actually happening. Unlike bank regulated credit, where the APRA has so much information on what's happening and they can regulate and make sure the banks are in good shape. This is much harder to see. And the IMF's chiming in here, as you'll see in this comment. I'll read this out. While the IMF says that offshore private credit portfolios are diversified across industry sectors and have virtually no exposure to real estate, Australian private credit is different. Our local fund managers have concentrated most of the portfolios on property, in particular loans to commercial and residential real estate developers. Now, we've seen some of those go broke in the last few months, and we've seen some of the private credit funds go broke along with that. There's a real worry that it's hard to know where the body is. Number one, we've avoided the sector. The Industry super funds in Australia have some exposure to this sector. Almost impossible to tell how much. They don't report on it. And hopefully they've done their due diligence well. But it's certainly a risk factor for anyone in industry super funds, one of a few at the moment. Let me jump in and bonds, boring old bonds, but it does give us an indication. You can see the yield curves have jumped almost to 12-month highs, not quite in the States. It actually eased back a bit. We're in the mid fours, 4.4 in Australia, 4.5 in the US. We had expected, if you go back a year ago, we were talking about a new normal of maybe high threes. It's bumped up partly because of the Trump factor. The bond market is just a little bit wary, partly because of slightly stubborn inflation, but not so much stubborn inflation, but the thought that rates might not drop as much. And higher bond yields means it's harder for equities to grow, particularly the growth, harder for their stock prices to grow. They've still grown, so the markets are still going up, but it's something we watch closely. And yeah, somewhere in that 3.5 to 4.5 is probably still the new normal, but there's a slight doubt. If Trump was to do anything crazy, for instance, the bond markets may react by pushing up yields. Now, we saw this happen a few years ago when Liz Truss in the UK made a whole bunch of what was seen to be irresponsible economic announcements, and the bond market punished by putting up UK Treasury yields, and that caused the pound to drop. So these markets are very much watchdogs in some ways on politicians trying to do crazy stuff. So it's going to be fascinating to watch, and more important than ever. No change. I always put in our context here, the wall of worry. We're absolutely in the wall of worry at the moment. We think it's expensive. No change to where we think the market is. A little bit expensive. Doesn't mean we get out of the market. Quite the opposite. And this year, if you do tune into the market outlook I did for the year, I think there's plenty of chance of volatility this year, but there's also plenty of chance that it's a really good year. If the market gets carried away with AI and tech, we continue the run. So there's probably a higher chance than normal of a really high performing year, but there's a higher chance of normal of a lower performing year as well. So I think we've got more volatility on the cards, but you wouldn't be out of the market. The gravity in the markets is up. In terms of my highlight on Mess It Up, I've gone to timing and selection. Trying to pick individual stocks is a mug's game. Those that have come late to the party in NVIDIA, for instance, with all the AI goings on, might get hurt a lot. We make no attempt to do that. We pick up NVIDIA through the broader stock indexes, just like we pick up all the other tech companies and all the other emerging ones. So by not trying to pick the winners there, we avoid the pitfalls that can happen when people are charging late cycles to some of the winners. Not saying NVIDIA is going to go down, but it's certainly gone up a lot. So it may well pause. I'm often reminded of BlackBerry. Remember the phones that every corporate executive had. Their stock price went up massively in the time that they were successful. And then all of a sudden, Steve Jobs came along with the iPhone, and 2 years later, BlackBerry was almost broke. So individual companies, hard to pick. Technology marches on. There'll be winners, there'll be losers, and it's good to own the whole index. Behavioral bias for this month is information bias. So this is one where we tend to overvalue any information that we've got just because we've got it. Sometimes because it's new. We've watched this week. All of a sudden, there was this announcement about the Chinese AI, and initially it was treated like it was absolutely 100% accurate, which no one will know, but also that it's way more important than maybe it is. So information bias is where we base our decision on new information without necessarily seeing a full picture, and we tend to overrate that new information, and it reinforces 2 other biases. Confirmation bias, because if we think something, we tend to then place more credence on information that supports that. That's confirmation bias. And we know that from all the studies, we overweight new evidence, new information, which is the recency bias. Just a reminder this year, I reckon it's going to be volatile. Maybe I'm going to be wrong. But volatility doesn't mean the market can't do multiple things this year. There might be a 5, 10, 15, even 20% correction, but we still could be here at the end of the year and have the market up 10 or 20%. So timing of it's just impossible. Volatility is inevitable. We have strategies in place that acknowledge that volatility is inevitable. And we can actually make money from volatility through clever rebalancing and using our reserves well. So let's have a look at the year to December. So Aussie shares finished the year at 11.36%. Yeah, and there was still a decent downturn in that year. Once again, there was a 10% downturn in the middle of the year. So we get these downturns even though the market goes up. It's normal. That is the wall of worry. The last 10 years, $10,000 in the Aussie market has grown to nearly 24,000. A sound investment with that 10-year return being about 8.5%, consistent with the long-term return of inflation plus 6 or 7%. So 10-year exactly as per 100-year history. You'll see Commonwealth Bank top of the pops when we look at what makes up the ASX 200, Commonwealth Bank, and quite a high price earnings ratio. But the Aussie price earnings ratios, despite being a little bit high, are nowhere near as high as the US. And you'll see in a minute when we look at US shares, for instance, with Apple at the top. Nvidia was at the top, so Nvidia's come back with this little downturn last few days. But you see the PE ratios into the 30s. They're high. They're not outrageously high. There's times in history where they've been higher than that, and they're all growing profits at the moment. We're eagerly watching the profit season this year to see how sustainable some of the big company growth has been. But they're all printing money. They're making serious profits at the moment. Make no mistake, and you can see that in the 10-year returns of anyone that invested in US shares, which is all of you, all of our clients, $10,000 up to 52,000, so 15% over the last 10 years. Now, about 4% of that is due for the Aussie dollar dropping, particularly during the first 5 years of that 10-year period. So if you're in the States, that returns about 12%. Still extremely healthy over 10 years, but not crazy above that long-term average of about 10, 11%. So global leaders, very similar. Lots of these are the US at the moment. So it's the same mix of Apple, Microsoft, etc. 10,000 grown to 47,000. And yeah, we've just seen, you can see since December close, the market's sort of going sideways, bouncing around on different news. But it's still really close to that long-term highs, but it's spectacular, 39% for the last year. US small caps more followed Australian shares. They're up 19% for the year, which is awesome. Their 3 years is a fairly modest 7%. We fully expect that at some point returns will broaden. What I mean by that at the moment, that the market last year, that 30% return plus on US shares was driven by the really big caps, that magnificent seven. And it wasn't there in the smaller caps to some degree, although they had a comeback. It wasn't too bad of a year, but we expect that to broaden out and small caps eventually outperform the larger caps over the longer term. Emerging markets had a comeback here, 18%, so better than Aussie shares, but it's been a pretty lean 5 years. You can see 5 years at 3%, 10 years at 5%. Still a critical part of the portfolio. And look at the price earnings ratios on some of these. They're in the teens or 10 for Samsung compared to Apple in the 20s and 30s. So they're just discounted because of suspiciousness from Western investors about China's stability around regulation, stuff like that, but incredible value when you're buying into emerging markets. And eventually that value will probably be realized by higher ratios and higher growth. We expect high growth over the longer run. Gold has just become a really critical part of the portfolio with volatility in currencies and everything else. We just enjoy having gold in the portfolio. It had a spectacular year, up 38%. And you can see that steady march up last year, which has been good for the portfolios. Let's have a look at the property world. And these slides are from my yearly analysis webinar that I talked about. But you can see this shows each city in Australia what happened between 23 and 24. So nationally, we went from growing just above 6% to just below 5%. Sydney went from growing at just above 8% down to about 4%. Melbourne went from growing at only 2% down to losing about 1.5% of value. So stagnation in Melbourne due predominantly to the land tax levy, which has caused more properties to be on the market than would otherwise be. So that's kept prices down. Brisbane maintaining its solid growth, about 11%, both from 23 and 24. Adelaide bumped up another notch. It was 10%, 23, and up over 12%. And I'll show you where all these cities fit in a minute. Perth still spectacular in that 16 to 17% range, and still more to come. So our partners that we refer clients that are looking for investment properties performance property, which I'll go to their analysis at the end, but they still think Perth has got plenty to run. Hobart jumped from a loss in 23 up to a modest growth in 24. And Canberra, not much change, pretty much stagnation around about 1% either way. So what that means, you can see the race here amongst all the different capital cities. Sydney quite clearly still the highest value median property in Australia, somewhere around 1.1 million. But you can see the order for the rest has changed dramatically over the last 5 years. So since COVID, you can see Perth, which is the grey line, has gone from second last, equal second last with Adelaide, to taken over and just giving Melbourne a nudge. So the value of properties in Perth and Melbourne now the same. Adelaide has actually taken over Melbourne, as has Brisbane. This will probably present an opportunity. It doesn't seem long run to be normal and sustainable that Melbourne is not the second most valuable city in Australia, just with the sheer population size. So Melbourne's dropped down to fourth or fifth. I haven't seen that for a long, long time. And I dare say there's probably opportunity in Melbourne to do a bit of catch up. And there might be some consolidation in places like Adelaide as well. So interesting times, as always, get good advice before buying property. It makes a massive difference. We've been putting, the clients have been buying properties into areas like Perth for about the last 5 years. So they've enjoyed a tremendous return over there. Population growth is one of the key drivers of property. And we saw COVID, a massive drop in population growth and a catch up. Most of that drop and catch up was overseas students leaving the country and then coming back in the country. So we will see it drop back to the averages around that 300 plus 340, 350,000 a year. And this does exasperate the property market. This is a fascinating stat that came from PropTrack and the ABS, but it looks at housing completions. So this is new annual dwelling completions per 1,000 of population. And you can see it bouncing around from highs of 9 or 10 and down to the lows at the moment. So we're at 40-year lows of closer to 6 compared to 9 or 10. Now, this is when we've got a housing crisis. So it's not helping your housing crisis, it's actually making it worse. And as a quote here from the article, I found this in, due to industry challenges like higher building costs and labour shortages, the supply side of the housing market's been unable to respond. So we just can't get houses out of the ground. And part of this is a hangover from COVID. So during COVID, governments went ballistic in announcing infrastructure spending, which was really valuable to get the economy out of the hole. But now all those projects they started back then are still going, and they're sapping a lot of the building workers into those projects, which means there's less building workers to build houses right when we need it. And we also had a 50 to 100% increase in different types of building costs as well. So that slowed it down. And there's no sign of that abating. So I think property prices are going to stay fairly stable, as much as they're expensive. They may not go a lot higher, but there's certainly a floor under it because of the shortage of property, or the property crisis, as people are talking about. Mortgage rates, absolutely no change. Mortgage rates are sitting there waiting for the Reserve Bank, so there's no action at all there. Still exactly the same. Some slight movements here, but this is for houses from Performance Property, where they see the world. And you can see Melbourne, who's had the worst of it, which has come down. But Melbourne's, somewhere in the next year or two, it'll probably emerge into that value buying. It's arguable it's getting closer to that now. Sydney as well, and country Victoria, and country New South Wales, which had such a tremendous run during COVID. Brisbane, still a hold. Adelaide, still a hold. Sunshine Coast, Gold Coast, towards the peak of the market. Now, that doesn't mean they'll necessarily go down. We've seen time and time again, sometimes those markets be reassessed and they'll come back to be buy value. But Perth still looking good value, and some of the second tier places in terms of property investments, regional Queensland, etc., are still looking like good value, and we've seen some rises there. As always, get some good advice on that. It makes a massive difference. So just reiterating, as always, our exciting life, boring money, our processes that keep us getting good returns without putting ourselves into dangerous positions. And that is all investing done as part of a real plan, whether it's based on your goals Portfolio is designed to meet those goals along with your risk profile. We take a long-term view, and then all the boring stuff, the beautiful boring stuff, diversification, asset allocation, and liquidity, which means we never have to sell good assets at a bad time. We do access 70 to 80% of the portfolio through low-cost index fund, which keeps costs down, which is critical. And we're protecting that short-term volume with our reserves for our retired clients and dollar cost averaging for our wealth accumulators. We rebalance regularly. It's a free lunch. So rebalancing the portfolios on a regular basis makes little bits of profit that more than cover the portfolio management fees. There's only 3 ways to lose money, and I'm pleased to say our clients just don't do it. That is panicking and selling at the wrong time, having to sell when markets are down and not properly diversified. We hope you're going to have an awesome year in life. It's going to be an interesting ride in world markets. So hang on, we might have a bit of a roller coaster, but ultimately, yeah, there's a lot to be optimistic about as well. Rob McGregor signing off, and until we speak again, yeah, have a great day. Cheers.